More and more our investors are thinking about an allocation to real assets as opposed to really fixating on the split between real estate and infrastructure. If data centres sit somewhere in the middle, if logistics sit somewhere in the middle, social infrastructure, that's what our investors are most focused on.
A clear investment strategy, broad coverage across real assets, and flexibility to deepen focus where the best opportunities in the market are. This is how PATRIZIA is set up to succeed in a world in transition. But how has this played out in the first half of 2026? And what does the rest of the year likely have in store? I'm Andrew Belt, and a warm welcome to the PATcast, the podcast from PATRIZIA, an investment manager in global real assets. In PATcast 35, I'm joined by PATRIZIA's Head of Fund Management Real Estate, Mahdi Mokrane, and Head of Fund Management Infrastructure, Europe, Phoebe Smith. Mahdi and Phoebe will take stock on an eventful 2026 so far and forecast what's around the corner in the world of real assets investment. So thanks for joining me.
Thank you.
When we first looked at the year from a fund management perspective, we very much looked at the dual megatrends. So the digital, energy, urban and living transitions. And 6 months on, having said that it was ripe for investment along those transitions, has this transpired? So Mahdi, I'll go to you.
To some extent, I think the big uncertainty we've seen in the Middle East, February, March, really put a dampening factor in the first half of the year. Probably brought more uncertainty. Investors probably wanted to stay a bit more on the sidelines, given the uncertainty that they were seeing on the energy prices, subsequent inflation levels, and potential implications on interest rates. However, having said this, the fundamentals are still very, very strong. And the investment case we had built up around the dual megatrends, entry points 25, 30% below prices that we had observed in 2021, 2022, that thesis is still very much there.
And on the infrastructure side, I'd say, echoing Mahdi's comments more broadly, in the mid-market, we certainly still see deal flow, which is exciting, and very much along those same investment themes that we've been talking about for some time. I'm sure we'll come onto it, but AI has obviously been driving a lot of investment activity and a lot of chat in the market. So data centres, fibre, and also all the energy required to power those data centres remain very key topics, as well as resiliency in our energy markets. So if we think about that global geopolitical uncertainty, that continues to drive the way investors are thinking about infrastructure.
And you mentioned the Iran war in your answer, Mahdi. That's one of these, probably the dominant news theme from 2026 so far. So looking back, what impact have you experienced both for the sector and in your personal engagements across real estate?
First thing we did, as we do in all major events, that actually put a new light to the house view. We traditionally do house views for our clients during the summer and at the end of the year. That helps investors plan the year ahead. And we revised the house view, starting in February, and we put several scenarios. Rapid de-escalation, okay, gradual sort of protracted negotiations, which we have to a large extent seen, and escalation. And we mapped that out to our investment portfolios. I think investors were keen to understand what were the implications by country. Which countries were more exposed, less exposed. They wanted to understand how that affected their portfolios, and also what that meant for inflation and interest rates, which are key determinants of cash flow performance and valuations. I think it really helped to map those three scenarios and then boil that down into individual decision-making for our investors. We discovered resilience, we discovered the power of diversification within portfolios, and we also discovered, the strengthening of our convictions, particularly around the, several sectors, such as the living sectors, for example. But I think we'll come back to that one later on.
And Phoebe, for you?
I think very much the same, looking at particularly the inflation protection that infrastructure can bring to your portfolio in a situation like Iran, where we are seeing those hits to energy prices in particular, that can actually be somewhat beneficial to some of the investments in our infrastructure portfolio, and more broadly, the inflation that it brings can also be a net positive. that investors like to see that diversification across their portfolio. And if we drill down into some of our specific investments, some of them have benefited from that higher energy price, for example, in our Nordic district heating businesses, where there is a correlation in the way that district heating is priced to electricity prices. There is a general uplift from these events. Obviously, marrying that with higher base rates and general uncertainty, which is having that impact on transaction deal flow, as Mahdi mentioned earlier.
And to stick with you, Phoebe, the dominant investment themes so far this year, so what would you say they have been? I think you've referred to the energy infrastructure market, and particularly in relation to the Iran war and the digital transition you spoke about in the first question. So are they the dominant investment themes you've seen in the market for the first 6 months this year?
I think I'd be lax if I didn't mention AI. We're seeing just, I think, across all sectors, the sheer quantum of change occurring, and therefore investors' excitement at what that can mean for infrastructure. What can they invest in that takes advantage of that trend? We're obviously seeing AI across all sorts of other use cases in our day-to-day work. How can we improve our processes and so on using AI? But fundamentally, from an infrastructure level, what does that mean? What can I invest in? What can I benefit from? And so the data center market is obviously the first element of that springs to most people's minds, and we've certainly seen a huge influx of capital across the data center markets. But it's not just data centers. You need the fiber to connect those, and moving forward, it's also the energy that those data centers are consuming. And so energy resilience from a geopolitical perspective has been a driving theme, but also energy sheer usage and getting that energy to where it needs to be. So looking at, is that co-locating new renewables next to a new build data center, or is it microgrids, or is it simply strengthening the grids we already have in place today? These are all very exciting investment opportunities within the infrastructure market, and we're certainly seeing the influx of capital following those trends.
And Mahdi, on the real estate side of things, you mentioned you might go into the living sector a little bit later in the conversation. Yes. Is that perhaps where you're headed when looking at the dominant investment themes this year?
I think the answer to the question about the dominant theme probably depends on the nature of the investor. And I have to say that if you poll investors in Europe, most of them would be at or slightly above their allocation to real estate in their global portfolios across multiple asset classes. So it's all about rebalancing portfolios, finding pockets of opportunities, and sort of reshuffling portfolios, maybe away from certain property types or geographies towards tilting portfolios to other property types or geographies. And that very much depends on how quickly capital comes back to them. I think what really now moves the needle is international capital, particularly if you look at Asia Pacific. Most investors in that region are underallocated to real estate, and they're looking to deploy globally. They have a quite attractive but very diverse investment landscape in Asia Pacific. And I think their dominant theme is whether to invest in Europe now or the US. They used to be very dominantly investing in the US. Things have changed, geopolitical tensions. The US market is richly priced, and now you see some attractive opportunities. So it's all about when and how to access Europe in scale. I think in terms of scale, it brings me back to, the investment themes. AI and data centers, as Phoebe has mentioned, is one key metric and theme. But the ability to find opportunities in continental Europe is not that straightforward. What's scalable, but it's a very different stream of cash flows, is living. And in particular, call it purpose-built residential as well as affordable living. And that really is where we're seeing a lot of action today.
And you were referring there to portfolio allocations in different markets, different types of investors as well. So when we spoke back in January, we were looking at portfolio allocations and the trends which we would foresee. There was a feeling that infrastructure might have a greater allocation over time, whereas real estate might be more variable. And I just want to ask at this stage, 6 months in, have you seen any trends from an allocation point of view? And Mahdi,
sure.
Back to you.
I think probably you asked me this question 3 years ago, I would have said the nature of the shock 3 years ago with the invasion of Ukraine by Russia, the impact on energy prices across Europe, which was way more meaningful in terms of magnitude compared to what we've been living through the last 2-3 months with the Middle East and Iran. That has led to a rethink around inflation protection and the advantage of infrastructure, or the perceived advantage of infrastructure as being an inflation head, at least immediately with explicit cash flow indexation, whereas real estate is more implicit and to some extent explicit. I think that has moved slightly with interest rates having sort of stabilized at a higher level than they used to be. I think the competition today for real estate is probably more with the 10-year bond yields, call it across Europe. Investors probably want the 10-year bond yield plus a premium. And that's really where they're seeking, the tilt towards over-allocating or under-allocating. So I think the movement has probably shifted from a competition between asset classes in the real world, in the real assets world, towards one between, say, real estate and the 10-year bond yields. Now the balance is probably where volumes are back to where they were on the 10-year average, but way significantly below where they were in 2021, 2022 at the peak of the market. We expect now, I think, the deployment to be more targeted towards certain specific sectors, and it's to some extent agnostic from property types. You see opportunities in offices, you see opportunities in infrastructure or quasi-infrastructure such as data centers. There is a big shift towards resilience logistics. There is high demand in certain types of logistics, catering to local ecosystems, call it, for example, business to consumer. There's also appetite for retail and the high yield space. But I think probably the biggest appetite today is towards, call it, residential or the living sector as a whole.
I'd also add that I think more and more our investors are thinking about an allocation to real assets as opposed to really fixating on the split between real estate and infrastructure. And, Mahdi mentioned a number of examples there that could sit equally within infrastructure or real estate, and typically thinking about that as a real assets portfolio and how do I get the set of cash flows that I'm after and the risk profile that I'm after is more where our investors are focusing. And so if data centers sit somewhere in the middle, if logistics sits somewhere in the middle, social infrastructure, you can go on with the list. But really they're looking at, am I getting that long-term set of cash flows, that inflation protection and a risk profile that I'm comfortable with? That's what our investors are most focused on.
So moving towards a more holistic allocation approach across real assets is a trend you've been
indeed
noticing, from your discussions with investors. And just looking back again, as this is the half-year review podcast, as heads of fund management, real estate and infrastructure, what have been the best achievements, would you say, so far from that perspective, from that lens?
Going back to the first 6 months of this year, I think we have a 45 billion portfolio. Clearly, we were seeing the tilt towards better performance and improved performance versus, absolute terms and in benchmarks. And this is across all asset types, from offices to industrial, retail, and the living sectors. But I have to say where we particularly focused our conviction, and we saw this because if you look at the next 5 years and you ask yourself the question, where can I probably underwrite a rental tone in 5 years' time with the most confidence? And it's probably an area where demand supply is really in your favor, where you have construction costs that are probably precluding a lot of the supply coming in. You have probably an area where there is a need, a basic human need. It could be food anchored retail, but it could be residential. And that's really where we have focused. So what I'm probably most proud of is the whole firm focusing on raising capital for our core fund, Pan-European Core Living Fund, raising capital and deploying capital for our value-add living program, and raising capital and deploying capital for our Sustainable Communities Impact Program on affordable housing. And all three themes, span across the living sector. They're mainly focused on residential, from affordable to standard mid-market, but they also focus on alternative living types such as PBSA, purpose-built student accommodation. And I think I'm particularly proud of having doubled the raising of the capital this year compared to last year, and also deployed. And one example is our forward funding program in Berlin, 500 million committed to probably one of the most undersupplied residential market in Europe. And that's targeting 2,000 additional residential units in Berlin.
And Phoebe, yourself, in terms of looking back the last 6 months, where would you say the achievements in infrastructure lie?
Well, we've certainly had a very healthy pipeline, and looking, as Mahdi mentioned, at our capital raising efforts, both here in Europe and Asia Pacific, that's moving strongly along. What we're also doing is, as mid-market investors, typically that means we are buying at smaller scale and building platforms over time. So there's been an incredible amount of activity within the existing portfolio to really execute on what we call our value creation cycle. So that involves bolt-ons, buying further through M&A, also organic growth within those companies, and making sure that we're really creating the best value we can out of those investments we've made over recent years. So a good example of that is our acquisition at the end of last year in a Nordic district heating business, Lunera. And the first 100 days of that plan was really about de-risking the business plan as we look forward, so that it's then in that great position to continue that growth trajectory. So that's making sure that the carve-out had been completed, that the management team was in place, that we'd put some energy hedges while energy prices were high to de-risk the forward-looking cash flows, achieve some cost synergies using all the expertise that the team has from our existing platforms in the Nordics and in district heating. And then now we've got a really great base from which to grow that platform over the coming years. And so that value creation cycle, whether that's refinancings, putting new financings in place, executing on those value creation levers that I was just describing, that's been a key focus of the team over the last 6 months as well.
And now this is the part of the podcast where we look ahead at the second half of the year. And I'm going to go to you, Phoebe, first. You're talking about the continuation of the portfolio management, the long-term plans which you have in place for value creation. So 6 months is perhaps a bit of a short window to be looking at and sort of commenting on what you see. But as to that pipeline, what are your next steps to take us up to the end of the year?
Great question. I think we're excited when we look at those value creation plans. We look at everything from investment all the way through to exit. So everything we're doing today is building towards an eventual exit of those investments. So there'll be some of that activity in the coming 6 months. But more importantly, we're excited by the pipeline in front of us, which I think we discussed earlier about very active energy and digital infrastructure investing at the moment. And so as a mid-market investor, a lot of that is in the co-location space for data centers. And then in the energy markets, there is a lot in energy transition and that sort of circular economy, if you like, of really building in energy as part of the solution to all of the other parts of a community. And so whether that's microgrids and things like that can really play into that energy transition, energy security piece, that's an exciting part of what we're looking forward to for the rest of the year.
I'm going to turn back to you, Mahdi, with the next 6 months and your pipeline of activity, which you see.
I think number one, keep focusing on delivering investment performance. And that's really not losing the ball on not dropping the ball on asset management initiatives, making sure our core assets stay core, particularly on ESG, and credentials, making them appealing to tenants, making sure we deliver our rental growth, NOI growth in our assets. I think that's really executing on the momentum and really taking care of what we can control. The capital markets, they're global, right? But we have assets under management. We can control a big part of the income cash flow. And that's what we're really focusing on. That also entails the structuring of our funds, putting debt in place where it's actually accretive and helpful. That's one. Number two, just maintaining the momentum we've built up for the first 6 months on capital raising. And I mentioned our core pan-European living. I mentioned our value add and our impact. But we're also pitching for new business in residential, separate accounts. We're pitching for probably an unloved sector today, which is offices. And it's great to be, with capital when actually no one wants to deploy, because actually the pricing is quite attractive. We're also active in retail, particularly in the world of higher interest rates, and the ability to offer higher yield on a long-term basis is quite attractive. So if we, make those big efforts, we'll be able to deliver some great news by the end of this year. And then finally, try to think about the next product. 2027, 2028 starts now.
That's great to be looking beyond already as well in terms of sharing what your plans are, where your focus is right now as well. And just to end and to take a step back from the plans which you have and looking back at the sector and your viewpoints there. So what are your expectations for the second half of this year?
I think investment volumes will accelerate. I mean, we're seeing, we started off with, global uncertainty. That's probably the number one. And I think Phoebe mentioned AI, which is also sort of the pervasive topic across the whole industry, the whole world. And I think with some of that uncertainty being sort of addressed in many ways, nothing certain, of course, but I think there is a bit of pent-up investment demand. Portfolios need to turn. Investors, some of them need to deploy capital, others need to sell to garner liquidity. So that sort of holding back or sitting in the sidelines will probably stop, and we'll see more investment activity, which I think is quite exciting.
And I'd certainly agree, I think in the infrastructure space, similarly, that we're hoping that the second half of the year will pick up pace further. And, the mid-market, I wouldn't say has really stopped, but certainly continue to see that momentum build throughout the rest of the year. And equally on the fundraising side, continuing to see that accelerate over the rest of 26.
Yeah, and we look forward to hearing more, strong fundraising news when we next meet and look ahead to 2027 in 6 months' time. So thanks to Mahdi and thanks to Phoebe for joining me and looking back at the first 6 months of 2026. And thanks to you for watching. You can continue to keep up to date with our Patcasts on YouTube or even listen on Spotify and Apple Podcasts. Thanks for watching.